we've only had 4 monetary contractions before this current one that we're in right now, and we had to go way back to find them. 1948, 49, we had one. 37, 38, we had one. Of course, we had a big one in 1929, 1933, and we had another one in 2021. All of those were followed by what? Recessions.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's expert was last on this program back in March, he predicted we'll see sub 2% inflation and a recession by the end of this year. Since then, headline CPI has remained stubbornly sticky above 3%. So, is 2% or less inflation by December still as forecast? Or have conditions changed? To find out, we've got the good fortune to sit down and get a full update today from Steve Hanke, Professor of Applied Economics at the Johns Hopkins University in Baltimore, Maryland. Steve, thanks so much for joining us today.
Great to be with you again, Adam. You want to hit the inflation forecast? John Greenwood and I originally thought with the contraction in the money supply and the usual lags that are associated between changes in the money supply and inflation, that we probably would be at 2% or below by the end of the year. Now, with the little plateauing that occurred earlier this year, where inflation was a little bit sticky, we did revise our forecast, and the end of the year forecast now that John Greenwood and I have is between 2.5% and 3%. So, and we'll get down to that 2% number a little bit later, probably the first quarter of next year rather than the end of this year. But at any rate, we did revise, and looks like we'll probably be in the strike zone for that revision. It's already at 3, and it'll probably come down closer to 2.5 by the end of the year.
Okay, so
but at any rate, the broad picture, by the way, on this topic, Greenwood and I have looked at 27 countries, and they've ranged all the way from the big economies like the U.S. and China and the Eurozone, UK, India, and so on, to smaller economies, emerging market countries, and of the 27 countries that we chose, they account for like 75% of the world's GDP. So, and they're all over the globe. So we looked at what we called eventually the inflation roller coaster. After the pandemic, what happened? Well, inflation went up, and then it's come down all over the world, and the story is always the same. The money supply got goosed, and the inflation roller coaster with a lag. It turns out, by the way, the lag is about 2 years. Actually, the mean lag in those 27 countries between the peak growth rate in the money supply and inflation is 23 months. The median is 23.9 months. And remember Milton Friedman's classic work with Anna Schwartz. He said that the lag between changes in the money supply and inflation be around 2 years, around 24 months. So that's exactly what we found all over the world. Now, the magnitude of the roller coaster ride is a lot different, by the way, depending on the country and how fast they goose the money supply. For example, you've got a wild ride, US, UK, Eurozone, Australia, Canada, New Zealand, Denmark, Sweden, Brazil, Egypt, Argentina, Sri Lanka, Ghana, Thailand, Mexico, Peru, Turkey, Philippines, and Israel. So that's where the money supply went up a lot, and then with a lag of about 23 months on average, you had the peak inflation hit. And in the United States, just to give you some, let me, before I jump into the United States, what about the cases where the roller coaster ride was kind of mild? It didn't amount to too much. China, Japan, Switzerland, Malaysia, India, Indonesia, South Africa. In those cases, the inflation roller coaster didn't go very high. And the reason it didn't go very high is the money supply didn't grow very much. If you look at China, for example, that was where the ride was pretty mild. After COVID hit, they didn't change their rate of growth in the money supply very much. Nothing happened. And it peaked out in February of 2021, the money supply growth rate in China. And then with a 24-month lag, inflation peaked out. What did it peak at? It peaked at 2.1%. That's not much of a wild ride. Now let's look at the United States. That's where we had a big wild ride. The money supply peaked in April of 2021. The rate of growth was 4 times higher at that peak than it was pre-COVID. And then with a lag of 19 months, inflation peaked out. And it peaked out about 4 times higher than it was pre-COVID. So the money supply in the US goes up at a rate 4 times higher, 4 times more rapidly. It peaks out. Then with a lag of 19 months, you get a peak in inflation, and then inflation peak rate was exactly 4 times higher than the rate pre-COVID. So the story is that inflation is not a worldwide phenomenon, number one. It varies depending on how fast the money supply is growing in each country. And these individual countries have separate central banks and separate monetary policies, separate monetary growth rates, and so forth. So, of course, the inflation varies all over the place, depending on what the central banks are doing with the money supply. So that's one thing. Inflation is not global, it's local. The second thing is inflation is always and everywhere a monetary phenomenon. I'm just quoting Milton Friedman here. Forget supply chain glitches, peak oil, COVID lockdowns, all of these non-monetary factors are symptoms of the changes in the money supply and changes in inflation. They're not the causes of it. So what people have been reading in the paper, it's just wrong from A to Z. Everything you read is about non-monetary factors causing changes in inflation. That's not the case. We always find that if the money supply changes, you get a lag of about 23 months on average, and inflation changes. So that is the kind of main message from our research. And the reason, by the way, that remember when inflation did go up in the United States, Greenwood and I hit the thing exactly. We said it would go up to as high as 9%. It peaked out at 9.1%. And now we got this reversal thing going with the contraction in the money supply. And of course, inflation's coming down. And eventually, but the important thing for people who trade is to note that interest rates and yields on bonds follow changes in inflation. So if inflation's going down, eventually the bond yields are going to go down. And if bond yields go down, what's that mean? The price of the bond goes up and you make a big capital gain. So that's the trade.
Okay, great. Like a good interviewee, you have taken your answer into several of the questions I was going to ask you. But it still.
Well, I apologize for cutting you off, but
No. You're making this a much more efficient interview, and you're getting us into the meat faster, which is great. Okay, so Friedman said inflation anywhere and everywhere, a monetary phenomenon. So your advice to folks is that the math continues to work with the equation of the quantity theory of money, which allowed you, and I do want to again give you props for, allowed you to predict with uncanny accuracy what the inflation rate in the States was going to go up to. I was one of those people who interviewed you quarters before we hit 9.1%. And I am one of those to validate you, to say, yes, quarters before we did, you said inflation's going to 9% later this year, and you hit it on the nose. And I know you largely accredit that to Milton Friedman's quantity theory of money formula. So you're saying the formula still holds. Don't get distracted by all the other reasons that the media throws in there for where inflation may head, because at the end of the day, it really is just about that formula. I guess the one thing I didn't fully understand in your answer, maybe I just didn't hear it, is given the formula, you were expecting to hit 2% or less by the end of this year. You've now shifted that timetable a bit. Now it's just 2.5% to 3% by the end of the year, declining further in 2025. What influenced you to shift the timing? Was it a change in the decrease of money supply? Was it something else going on?
Well, no. It was just the fact that we hit that little plateau for 3 months, 4 months, where inflation didn't change very much. It didn't go down as rapidly as it didn't go down kind of in a linear straight line.
Mm-hmm.
It kind of went down and then plateaued out, and then now it started going down again, and it's just a matter of the arithmetic. I mean, you just look at the numbers, and with the plateau stalling things out for 3 or 4 months, the numbers just don't add up. You don't get 2%. You're going to get 2.5 to 3.
Okay, so
it's just an arithmetic thing.
Got it.
We know the general trend and what's going to happen with the money supply contracting, and that means the inflation contracting. But when you look at economic data, you have to realize that if you're looking at things in real time, it can be kind of noisy. I mean, it doesn't just go down and always in a linear way. It kind of zigs and zags around. But the trend, even if you look at the zigs and zags, it's going down. And it's going down because the money supply started going down in July of 2022, and is lower now than it was in July of 2022.
Okay.
By the way, yeah, go ahead.
What is the current impulse on the money supply? Is it still decreasing?
No, on a year-over-year basis, it's increasing just a little bit. Not very much, but a little.
Okay. Did that make you think that it has troughed?
Well, it makes me think that whatever is happening to the money supply now will affect what we see in 24 months.
Absolutely.
In inflation.
Absolutely, I get that. I'm just wondering, because this is a big trend, right? I mean, the fact that money supply went into decline was a major shift, because that didn't happen super often in the way that it has over the past year and a half. And so if and when that reverses, that will be important to note. Is it too early to call a reversal?
Well, not really, because when I say it's anemic, we're down at like 1% or something like that year over year, a growth rate, and to hit the inflation target of 2%, and using the quantity theory of money, Hanke's golden growth rate would be about a 6% growth rate. Mm-hmm. So it's still way below where it should be to allow for eventually hitting that 2% target that the Fed has. So it's not only, it's reversed, it's contracted. Now it's kind of stabilized. It's growing a little bit, but still way below the golden growth rate. That's why they should get rid of quantitative tightening and loosen up the Fed funds rate a bit.
Okay. So reason why I'm asking all these clarifying questions is because I'm trying to get to a bigger one, which maybe I'll get to now. So prior to COVID, the challenge that we've been told, by the Fed was, hey, we're not worried about inflation. We're still worried about, potential deflation of the system. And we can't even get 2% inflation yet, right? Now, COVID happens. They go monetary and fiscal sides go bananas with their policy bazookas. Money supply goes crazy, creates this inflation that we've now seen. The inflation is now moderating because the money supply has been shrinking, as you've been telling us, but it still is below what you would consider to be the healthier / golden growth rate. So where I'm going with this is everyone's still worried about inflation. Isn't it going to be sticky? And are we in a new secular era of higher inflation and all that stuff? And I hear you saying you're not that worried about that because you think inflation's headed down to 2% or less because of the math. The big question I have is everybody worried about slaying the wrong dragon here? Are we focused on getting inflation dead when the big one is maybe we're going to have a big deflation problem at some point?
Everyone is off base, and the reason is quite simple. The Fed, given cover by contemporary macroeconomists, has the story all wrong. They have deep sixed money. They don't look at money. Money isn't even in the post-Keynesian macroeconomic models, Adam. Money is not in there. And so they have, and so that gives the Fed cover, and the Fed does what it always does and what central bankers always do. When inflation comes, the old line, it's not me, it's the guy behind the tree. Well, the guy behind the tree is all this non-monetary stuff. Supply chains, oil price increases, lockdowns we had, you name it, a million non-monetary reasons that they claim caused inflation. And then they sing the song, they say, oh, the reason inflation is going down is that we cleaned up the supply chain glitches. We fixed all that. So they fix all the non-monetary stuff and inflation goes down. Now that's their line. And it's really a whitewash of the whole thing. And the press, of course, repeats it. So most of your viewers who are reading the newspapers are reading about all this non-monetary rubbish that causes inflation. No, that's incorrect. They have the wrong narrative. They have the wrong macroeconomic models. If they're studying economics at most universities today, they'll be using some version of a post-Keynesian macroeconomic model that doesn't even include money.
So what are the dangers of that?
That's where they're slaying the wrong dragon because they've been reading the press, or if they're more serious, they've been looking at an economic model that's the wrong model and doesn't include inflation. And of course, the proof of the pudding is none of these people were able to do what John Greenwood and I did, and that's predict where inflation was going.
Okay, so I totally get it. So the power structure is focused on slaying the wrong dragon. What are the dangers? What do you think the outcome of that is going to be? Will they be surprised on the side of deflation at some point here, or is there a different risk you think is
well? The problem is the roller coaster that I talked about. It goes up and it goes down and up and down, and depending on the country, It doesn't go up and down very much in China, for example, because they've kept the rate of growth in the money supply about the same. In this 2020 2024 period, same with Japan, same with Switzerland, same with Malaysia, same with India, same with Indonesia, same even South Africa. They had little changes in things, and as a result, the roller coaster wasn't very exciting.
Right.
It didn't go up very high. And
so just to use a roller coaster analogy, the roller coaster gets as exciting as the ride operator, how much he pulls that lever back and forth, right? And those countries you just mentioned.
Absolutely. And if just to stay on this thing, that's a very good thing you pointed out with the lever. If the operator has the wrong chart in front of him and is looking at the wrong thing, he's going to be swinging that thing back and forth and back and forth. And when it gets too high, of course, he's going to be scared and he's going to pull the thing way back. You want to keep it steady. In the US, you want to keep that lever so that the roller coaster is flat. The inflation is flat at about 2%. And to do that, the rate of growth in the money supply measured by M2, broad money supply, should be about 6% a year. And that's what it was prior to COVID, by the way. All the period of time since the Lehman collapse, remember the great financial crisis, 2007, 2008, the money supply never increased very much. It stayed pretty much flat, 5.5%, 6%, on and on and on. And what was happening to inflation? They could barely get it up to 2%.
Right. So, okay, so I'm going to connect a couple dots from previous experts that have been on the show. So I've interviewed Lacey Hunt in the past, and he has been definitely saying, look, he's in your camp. It's all about the math. He sees deflation as the inevitable outcome of the current math. Then Felix Zulauf has kind of said, look, I expect the rest of this decade to be the decade of the roller coasters, literally use the same analogy. So are you expecting to see, as we head into next year, the inflation rate continue to go down, maybe now continue to go down farther than the Fed wants it to? We have some sort of deflationary scare, asset prices start coming down, the economy gets more wobbly, and then the operator, the Fed, puts a ton more juice into the system, and then all of a sudden, two years later, voila, we're back to high inflation, and we're stuck in this roller coaster of, oop, we had too much, now we have too little, oop, we had too much, now we have too little. Are you worried about that?
I think, given the fact that the Fed has the wrong macroeconomic model, and they're not looking at the money supply, the likelihood of the roller coaster is with us, with the Fed. Now, the amplitude, how high and how wild the ride is, that's another issue. But the roller coaster will be with us as long as the Fed is operating with the economic model and thinking that they have, which is completely excluded money. I mean, here's an institution that's responsible for monetary policy and the production of money in the United States, and they don't even look at money. I mean, it's complete madness.
Yeah,
I guess that's why that's why I would give them this recent episode, by the way, of up and then down. It's terrible, and I would give them an F for the performance, the Fed. The money contraction thing, by the way, we've only had 4 monetary contractions before this current one that we're in right now, and we had to go way back to find them. 1948, 49, we had one. 37, 38, we had one. Of course, we had a big one in 1929, 1933, and we had another one in 2021. All of those were followed by what? Recessions.
All right. So just make sure I heard your list clearly. The last time we had a money supply contraction like this was 100 years ago.
Yeah,
And
48, 49. 48, 49. It wasn't 100 years ago. It was
okay.
the first one was 2021. That was about 100 years ago. And then we go 29, 33, and then 37, 38, 48, 49, and now 2022. So there was a big jump from 1949 was the last time we had a contraction, and all of a sudden now we've got what, 70 years.
Okay, great. So I did mishear, but this is rare territory. It's territory that basically nobody alive has ever navigated before, right? And the data shows us that after you have a contraction like this, more often than not, and certainly as it makes sense given Friedman's formula, you have a recession.
Well, not everybody. I mean, I was 7 years of age in the last.
Yeah, but you weren't an operating professional. You don't have any career experience during that.
Well, no, I almost did, because I actually started hedging with my grandfather in about 19. I was 10, so it would be 52. So I was pretty close to it.
All right, but I hate to say it, Steve. You and people like you in that is a small percentage of folks still alive and what.
I agree. I don't need to be a wise guy with it.
No, not at all. And yeah, and maybe you're the best candidate of guy who has the closest experience, which means you were sort of semi-interested in this stuff when you were 7, right? We've got nobody that's actually navigated it before.
I was interested in it because I'm a country boy from Iowa, and everything in that part of the world, everything is geared to prices. The price of cattle, the price of hogs, the price of corn, the price of soybeans, the price of an acre of good Iowa farmland. That's life. That's all anyone is talking about all the time. So even at 7 years of age, believe me, you were glued to what? Every day at noon, the livestock reports on the radio, whether you wanted it or not, because your parents or your relatives had the radio on listening to the thing, and you couldn't escape, or you were listening to the weather report to figure out if it was going to rain and the corn was going to be good.
All right, well, look, so again, you're underscoring the importance of price, which again is sort of why Friedman's formula comes back into play here again. And here you're saying the Fed is like a weatherman whose predictive models don't take into account precipitation, right? You're saying if you're trying to predict inflation, you need to look at money, but they don't look at money in their models.
Yeah. So what would happen with a weatherman if the weatherman's predictions were as bad as the Fed's have been on inflation? What would happen to the weatherman?
Well, you'd expect he'd be fired after a couple of days. Yeah,
he'd be axed. So my suggestion, and I think they should really change the governance and rules of the Fed. I think that if the inflation target is 2%, and on average, we can work out the exact metric, but on average, let's give them a 2-year period, because you've got a 2-year lag usually between changes in the money supply and changes in prices. If they can't hit that on average over a 2-year period, the chairman of the Fed should be fired. That's my recommendation. This is the first time I've gone public with this thing, and I'm actually writing it up, because there's something pretty close to this in New Zealand. Remember, where did inflation targeting come from in a practical way? I'm not talking about theoretical, but because I think the idea of an inflation target, actually, Knut Wicksell, the great Swedish economist, work this out in his theoretical works. We're talking about 19th century, early 20th century. My colleague and collaborator Lars Jonig at the University of Lund in Sweden has just worked all this out recently. He has a paper that hasn't even been published yet, but Wicksell had the idea of inflation targeting. Then you add the practical implementation of the target of 2%. Where did that come from? It came from the Reserve Bank in New Zealand. And if you look at all the laws associated with this in New Zealand, the governor of the Reserve Bank of New Zealand, if he's not hitting the inflation target, he's on pretty thin ice. It's not an automatic firing. It's a little bit vague, the law, how it works, but he's vulnerable to being fired.
How much has that been enforced? Have they dialed through a couple of governors there because they failed their targets?
No, they haven't yet. No, but I have been in touch. My good friend Sir Roger Douglas was the finance minister when they actually got that idea in, and I have been in correspondence with Sir Roger recently, and his understanding and the intent was that the governor would be fired if they didn't hit the inflation target. Now, upon further investigation, he sent me other documents and so forth. If you actually look at the law, it's got a little wiggle room in it, if you know what I mean.
Sure. And hey, politics will always find a way.
Yeah. So far, missing the inflation target in New Zealand has not taken the head of the Reserve Bank so far.
All right.
But it could.
Well,
I'm suggesting something more ironclad, where it was just automatic. If over a 2-year period on average you don't hit it, you're out.
Well, I think a lot of these viewers this video's viewers would agree with you. It's pretty hard to imagine a less accurate track record than the Fed has in predicting inflation. And of course, everybody can even remember the recent transitory debacle. All right, well, look, I've got some big questions that fall out of this. One is, which you already sort of alluded to, but let's talk about anything else that needs to be talked about it, which is the direction of interest rates. Interest rates are generally a function of inflation expectations. Sounds like you feel like the market will catch on to the trend that you're predicting here, and I imagine you expect interest rates to march downwards over the next couple of years. I've had a lot of debate on this program, Steve. It's funny, inflation and interest rates, because they're related, is probably the topic that I see the greatest difference in outlooks on the folks that I interview. And there are a few that think there's a great opportunity coming up in bonds and are positioned for it. They've been taking some slings and arrows over the past year because it hasn't materialized as swiftly as they initially thought it would. Then there's other people who are saying, hey, no, we're in a secular, new era of high inflations, high interest rates. The 40-year interest rate trend has bottomed, and interest rates are going to be higher going forward. So this is a very high interest topic, and it's one that people are placing big bets on either side. Sounds like you are pretty firmly in the camp of, hey, long government bonds, probably a pretty good investment over the next year.
Yes. Now, this is a little bit nuanced because remember, since roughly 1990, we were in one of the biggest bull markets in bonds in the history of man, and I do think that's probably come to an end. Okay. But as a trade right now, I think the 10-year bond is probably a very safe bet and will garner a nice profit because money supply is contracted, inflation's coming down. Interest rates and yields always follow inflation, so the yields will come down on the 10-year, and so as a trade, even though I think we've seen probably the end of this massive bull market in bonds, I think as a trade, I'd want to be long the 10-year, and maybe not the kind of thing. Remember the 1990 kind of deal. You just bought a 10-year and put it in the safety deposit box, and you were golden. That's not what I'm saying now. I'm saying don't put it in the safety deposit box. Trade it.
Yep. This is more of a trade than a long-term position.
Right. It's not a long-term secular perspective on things. It's more of a short-term to intermediate one, in which we know, by the way, that inflation coming down is baked in the cake because of what happened starting 2 years ago,
right,
with a contraction of the money supply.
Right. So you have the confidence of the math on your side.
That's why it's easy for me to say these things. It is baked in the cake. There's nothing. It's going to happen.
Okay.
Because the money supply changed. We know that is a fact, and we know that these lags are roughly about 2 years between changes in the money supply and changes in inflation.
So I love finding opportunities like this where it feels like it's math and less, opinion or a strongly felt, assessment. Two questions related to this. One, given the math, you said you expect us to be at 2.5% to 3% inflation by the end of this year, for it to continue going downwards to 2% or below next year. What is the math telling you in terms of where you think the bottom is here? Is it 2% inflation, or do you project it to be materially below that?
Well, I think it's going to. It depends on what they do. Remember, a few minutes ago we were talking about the course of the money supply, what had happened, and I said, well, it's not still going down. It's actually, if you look at year over year or 3-month or 6-month annualized, it's going up a little bit. It's still anemic and below the 6% required data 2% inflation target, but it depends on what the Fed does going forward. So to get to the bottom, I would have to know, well, what is the Fed going to do over the next year or so?
Okay, but let me ask you this. So if the Fed starts changing the money supply now, that's the impact of that is not going to be reflected for a long period of time because of the lag, right? So
right.
What is the current math we're seeing here? And I know I'm not asking you to predict with exactitude.
I would say 2% or a bit below.
2% or a bit below. Okay, and I'm just making sure you're not saying zero.
Yeah. No. I'm not.
Okay, so then second question is, okay, so I like this trade. I'm buying the 10-year. What would give you a sense once you're in the 10-year that it's time to get out of it? What would you be looking for to say, okay, I think this is going to, I've made the money I'm going to make, and now these new developments make me think it's time to sell?
Well, it would depend on how where in fact inflation did end up bottoming out, and how long it stayed kind of on the bottom, and what the so-called inflation expectations were that people were thinking about in the market. I mean, it would depend on a number of things, but I think the main thing in trading is to get the direction of things right.
Sure.
And worrying about all these precise levels and targets and everything, it's not the way to do it. We wait until you have the position, you're in gear, you're and just then you have to start thinking a little bit more about real-time data dependency, what's going on in the markets and so forth and so on. But generally, as soon as I felt comfortable that the inflation rate had more or less bottomed out, I would be thinking about getting out of the 10-year.
Okay, great. And Steve, can we make a deal that if this indeed follows the trajectory that you expect, that you come back on when you start thinking, okay, the trade's probably played out?
Yeah, yeah. You know, as soon as you've squeezed all the juice out of the lemon,
Okay.
get rid of
Get rid of the lemon. Yeah.
The trade becomes a lemon. Get out of it.
Okay, so here's my other big question with all of this. So money supply contraction is rare, right? We just said it hasn't happened for 75 years or so. It's already looking like it's starting to grow again. TBD, we'll keep an eye on it, but let's assume that it is, right? You think it's growing too little, that you think the golden growth rate is around 6%. So with a money supply that grows annually at 6% on average, by definition, that will inflate away the purchasing power of the currency over time, correct? So sort of where I'm going with this is, are all fiat currencies that have to grow at this type of growth rate that we're talking about, are they all sort of dying regimes when it comes to purchasing power? They're just dying at different rates.
Well, yeah, there's an inflation target every place. They're all positive. Now, there might be some that are zero that I'm not aware of, but most of them are around 2%, and some, in especially emerging market countries, are higher than 2%. But so what happens with this money that's growing at 6% a year? About 2%, the potential growth rate in the U.S. is just a bit over 2%. Let's say it's 2%. That's the real rate of growth. And then you have the demand for more money in people's portfolios as income grows. That's about a 2% increase per year. And then you've got the inflation target of 2% per year. So 2 plus 2 plus 2 equals 6.
Got it.
Just as a rough back of the envelope kind of calc. That's what's going on. And as far as fiat currencies, you have to be very careful about this, because people get carried away. They say, "Oh, the dollar, we have this inflation and so forth and so on." Well, and the dollar's going to pot and it's losing purchasing power. Well, it is losing domestic purchasing power, by the way, the dollar. Because of inflation, the inflation tax. Okay, that's true. But relative to other currencies, it's the best dirty shirt in town.
Yep.
It's tremendously strong, the U.S. dollar right now. Good. Take your summer vacation in Europe or any other country, and you'll find out how cheap things are, because your purchasing power vis-a-vis those other currencies is increased. It's very strong. Now, and as they say, as a trader, buy dollars, wear diamonds. So you got to be careful. You start trashing the dollar, and you generally are going to have problems. Now, the only currency, by the way, that is not lost real value over time since about World War II is the Swiss franc.
And is that because of their money supply and how they manage it, or?
Yeah, well, no, they've managed the money supply very well. Remember, the Swiss, on my list of countries where the roller coaster ride was not very wild, Switzerland was one of them. We had China, Japan, Switzerland, Malaysia, India, Indonesia, and South Africa.
All right. So just to clarify my question, if I was trashing anything, I was trashing fiat currencies in general. And as I said, are all fiat currencies a dying regime? Some just die at faster rates than others, right? So absolutely, you go to Japan or Turkey right now, your dollar buys you a lot more than it did a couple of years ago. But in all currencies, in all home countries, they're losing purchasing power domestically. And certainly here in the States, as you said, we've seen a big injury over the past 4 years. So if that is indeed true, my question was going to be, what can the regular investor do to protect themselves? Is it, holding some assets in their portfolios that don't inflate away, like precious metals or maybe Bitcoin? The day we're talking, the new Ethereum ETF just launched. Or do you have a different strategy to recommend?
Well, I'm pretty old school, I guess, but maybe smart school would be a better adage. And a little gold never hurts.
Okay, a little gold never hurts.
Or if you're really worried about it, I mean, and look at the historical record, the only currency that's actually appreciated in real inflation-adjusted terms since World War I is the Swiss franc. That's the only currency in the world. And in some of that time, by the way, since World War I, these things weren't all fiat. I mean, we've only had that since 1971.
Right. I'm curious, do you see any country eventually, making the decision to switch back to some sort of backed currency?
Well, as my old friend and mentor and Nobel laureate Bob Mundell wrote and actually wrote in his Nobel address that gold would always play a role and always has played a role in the international financial system. So maybe, I mean, it's playing a role now. I mean,
yeah, we're seeing increased buying, right, by central banks.
Huge central bank buying, and the price is quite strong, and I think will remain so. The only other thing, of course, this comes back to my roots in Iowa. Land. Mm-hmm. They don't make it anymore. They don't make good Iowa farmland anymore.
Right. Okay. And I was going there, which is sort of other hard assets.
So you buy it. Why do you think people like? Well, the biggest landowner in the world is King Charles. But Bill Gates is way behind, but he's not bad. And why do you think all these billionaires have quite a bit of land in their portfolio? They're it's the kind of thing, you get a good manager who manages the property, and you basically go to sleep and wake up every morning and the value of the thing is higher than when you went to bed.
Right. And it generates productive rents, right? If you're growing,
right,
growing
exactly.
food on it, and you're getting paid for it, you're helping the world and making money. Yeah.
So I would say that the easiest thing is land, actually.
Okay. So land, some precious metals,
land, a little gold.
Land, a little gold, maybe a little bit of the Swiss franc in your portfolio there.
The Swissy, you're not going to go wrong on that.
Okay, and I'm trying to remember. I seem to remember you have a strong opinion. I just can't remember which way. For the Bitcoiners watching, what's your opinion on that space?
That's a highly speculative asset with zero fundamental value. So Bitcoin, for example, the work that's been done on that, if you put some of that in your portfolio, it is a highly speculative asset. It increases the risk tremendously, and the quality of your portfolio is going to go down, not up. But if you want to take it, that's fine.
Okay.
It's not like land where you go to sleep you wake up the next morning and it's always, it's, worth a little more than it was when you went to bed. That's not the case with Bitcoin.
Got it. And I'm sure we're going to get all.
You got to think about it this way. Realistically, do you like to go to Las Vegas and gamble? I mean, some people do, and that's a lot of people do, and that's fine. But I think it's just kind of a waste of time as far as I'm concerned, and the reason why it's highly speculative. And any form of gambling is highly speculative, and if you don't have the tolerance for a high degree of speculation, stay away from it. If you like to speculate and have a good tolerance for it, fine. Who cares? Who cares? It's your money. It's not mine. It's yours.
And just because you made the analogy, and I this is a topic which people have very strong opinions on either side, so I'm sure we're going to see some pushback from the Bitcoin crowd here. But if you make the casino analogy, obviously one of the things that you should keep in mind if going into a casino is that the odds are in the house's favor over time. Do you feel a similar risk in the Bitcoin world?
Oh yeah, there's no question about it. The big fish are much different than the little minnows in the Bitcoin market, believe me.
Okay. All right. Well, look, just to wrap up,
with the big fish being analogous to the house.
Got it. And it is. I mean, if you look at the
the Bitcoin people, it's a little bit of like a religion, and they get themselves all worked up. If people want to speculate on Bitcoin, that's their problem. It's not my problem. It's their problem.
Okay. But it does not sound like it's in the Hanke's recommended basket of assets, given your current macro and market outlook.
Not at all. I think that degree of risk taking and speculation, again, it depends a little bit on your age. By the way, if you're young, you can take a lot more risk than if you're old.
Mm-hmm.
Because you have a lot of years to start over once you get wiped out.
Yeah. All right. Well, look, just to round out the asset discussion, are there any other assets that we haven't talked about that you think are worthy of consideration given your current outlook?
Well, yes, I think at present, I think the current market in the U.S., the equity market, is very, very pricey. And it's probably bound for a pretty big correction, especially when the recession hits next year. That doesn't mean that I'd be bailing out of the stocks that are good that you're riding, ride them. But be cognizant of what I said. And contraction in the money supply is going to lead to continued decline in inflation, continued decline in interest rates, and probably a recession early next year. So you got to keep your eye on the ball and know when to lighten up. But there's basically, it's very hard to find anything worth buying in the market right now. They're really, if use my Warren Buffett rule, if there's anything below a PE of 15, it might be on your radar screen if and only if you anticipate earnings to continue to grow for the next 5 years. And when I say continue, with a 90% probability, and that there's a 50% probability that the rate of those earnings growth numbers will be 7% a year for the next 5 years. So PE is less than 15, 5 years of earnings growth, and that's with a 90% probability. You're almost positive that's going to happen, and you have a 50% probability that the earnings growth over the next 5 years that you're anticipating will actually generate earnings growth of 7% per year for the 5 years. So if you put that in, there's just not much out there worth buying. But hang on to your good stocks, ride them. The market's clearly in a bull market, ride them, but also you got a yellow light should kind of be on, not a red light, but a yellow light, because we know this contraction in the money supply is very unusual, and it will. All the contractions have always led to recessions. Remember, I went through this before. Those 4 prior contractions in the money supply were all followed by recessions. One of them, a Great Depression. The 29-33 contraction in the money supply led to the Great Depression.
And it just begs the question, so why will it be different this time? I don't think you necessarily think it will be, which is why you're calling for a recession next year.
No, I don't think it'll be. I don't think it'll be any different.
Okay. All right. Well, look, Steve, thanks so much. I'm going to start wrapping it up, but just to make sure I took good notes here. You said, I kind of hear you making an argument for if you're going to, continue to be long U.S. equities, it's really a very active management game versus a passive management one. You can't really just buy the sector or buy the ETF. It's really about trying to find companies that fit the filter that you just mentioned, of which there are precious few out there right now. So you really basically have to do your homework, is what I'm saying. In addition to that, and stay, ride your winners, as you said, but with an eye to the fact that there's going to be a sell moment coming up because of the recession that you see ahead, and you want to be ahead of that sell moment. You like long-term bonds for the reasons we discussed earlier about inflation and interest rates. You like land, particularly farmland. You like gold, and you like the Swiss franc. All right. Well, look, as we start to wrap things up here, Steve, again, thank you. And again, the invitation is open for any time you see a material change in your forecasting there. Please let me know. We'll have you come back on the channel so you can update folks. For folks that have really enjoyed this discussion and would like to follow you in your work between now and the next time you come on this channel, where should they go?
Follow me on Twitter at Steve_Hanke, or send me an email requesting to be put on my distribution list, and that should do it. Until the next time, I think you indicated you did have a final couple of question or something you wanted to raise with me.
I do. Real quick, Steve, can you just give your email address verbally? When I edit this, I'll make sure I put up the links to
okay.
Twitter and email on the screen.
The email address is Hanke, Hanke at jhu.edu.
All right, awesome. And yes, so my last question is, Steve, you a highly respected economist. You have a massive following on social media that's very well deserved. Great track record, and just a very successful career. What's one important lesson that you've learned along your journey that you think is worth sharing with the audience today?
Actually, it's kind of a 1-2 punch. The most important thing is picking the right partner. Fortunately, I picked Mrs. Hanke, a great lady from Paris who decided to join me in Baltimore. We live in Baltimore, actually in Paris, and that's the first and most important thing. The second thing is keep your nose to the grindstone. Work. Nothing comes free in life.
Nothing comes free, and I imagine there's part of the Alice Duckworth philosophy in there, grit, right? That it's not always the smartest person that is the most successful or the most talented.
Absolutely. I've got her book, and grit is analogous to my keep your nose to the grindstone. That's what we learned when I was a kid in Iowa. But grit was, I don't know when that came into the picture, but in my youth, it was keep your nose to the grindstone, Hanke, and you'll stay out of trouble and probably do okay.
All right. Well, great life advice. I echo both of those full-throatedly. And very impressive that you convinced somebody from Paris to come join you over here living in Baltimore, which of course is the Paris of America. So I guess that makes sense. But anyway, Steve, thanks so much. Great discussion as always, and look forward to having you back on the program soon. But like I said, the door's open anytime you want to come back on, even before our next planned one.
Well, that's great, Adam. Thank you. Great to be with you.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial. They're one of the financial advisory firms endorsed by Thoughtful Money. I'm joined as usual by lead partners there, Mike Preston and John Loderer. John, why don't we start with you this week? What were some of your key takeaways from the discussion there with Steve?
Hi, Adam. Great to be with you here again this week. Really like Steve's talk. What I really liked about it, what we liked about it is it cuts right to the chase as to, the simplicity of, look, when you greatly expand the money supply in an economy, it's going to have follow-through effects. And the simple eloquence of the quantitative theory of money that Steve is very much a practitioner of is hey, look, you can blame all kinds of supply chain things, the supply shocks, whether it's in oil or semiconductors. But at the end of the day, what really drives inflation, and he and his co-author, John Greenwood, I believe is his name, have put out some research that shows there's a very tight relationship between changes in the money supply, M2 to get technical, I think he looks at, with inflation. And he gets even more precise that it's roughly about a 2-year lag, meaning when money supply has major spikes higher, typically the inflationary cycle is going to be kind of expressing that 2 years later. Actually, I think he said actually 23 months on average. And not only that, but the magnitude of the roller coaster ride. Certainly, we have seen a roller coaster ride as relates to inflation here in the U.S. And he says the magnitude of that roller coaster ride is very much a function of the extremity or how extreme the expansion of the money supply has been. So in countries like China, Japan, Switzerland, South Africa, and you named a bunch of others, where their kind of expansion of the money supply was much more modest than, for example, here in the U.S., they likewise saw less of a spike in inflation as compared to here in the U.S. And the opposite is true. We saw a spike up to 9.1%, eerily close, I think, to what Steve and his research partner there had predicted. So I like the simplicity, and he likewise basically holds no punches, I think, in criticizing the Fed and its kind of convoluted and lack of rules-based models to that completely miss the point in his view that one way or the other you're going to see inflation. We've seen over the last decade massive expansion of money supply. Maybe didn't express itself early on in the decade in the form of consumer prices, but certainly asset prices saw massive inflation, unhealthy and unnatural inflation, we would say. But more recently, in recent years, that has expressed itself at consumer prices. He does think we're on the downswing. He projects that by the end of this year, we'll be firmly within the 2 to 2.5%, 3% range that they have projected. They moved their forecast out a bit from as a result of some sticky inflation episodes earlier this year, but he thinks we'll be closer to 2.5%. The one area, we'll get this later, obviously we're investment people. Obviously the economic stuff certainly plays into the investment landscape, but oftentimes economic things don't really predict or aren't reliable indicators as to how to invest. And so we take in a bunch of economic analysis like what Steve puts out. But at the end of the day, we're going to follow markets and invest based upon what our markets are telling us. And I'll pick one little bone. We agree with him that the 10-year Treasury bond, for example, is likely a good trade rather than a long-term hold. And we do have a modest allocation of about 10% right now for clients. But getting really precise on that, his simple comment that when inflation comes down, so too do interest rates. We can get into this later, but it's not quite that close of a relationship. And you can look at, for example, even since inflation has declined since the middle of 2022 from 9.1% here, bonds have not been a good. In fact, bond yields have risen pretty much as inflation has dropped. So we'll pick a little bit of a bone there in terms of the precise timing of those trades, but all in all, we really appreciated his comments and think it gets right to the heart of the problem that has been infected in the world, not just our country, but this massive expansion of money supply. So I'll pause there. I'm sure we'll dive in to a whole bunch more here.
Okay, well, thanks, John. Great notes, and yeah, one of the things I appreciate when I talk to really long-term seasoned economists, they're the guys with the math on their side. And like you said, not everything unfolds in the real world the way that it unfolds on the chalkboard. But over the long scope of things, with enough time, the math generally wins out. And Steve's point of view is shared very much by another great economist, Lacey Hunt, who really focuses in on money supply and other proxies for it, like what is it, ODL? I think it stands for other depository liabilities. To him, it's again just a story of math. When that stuff starts shrinking, the economy has to react. And as we talk about a lot in this program, it acts with lags. The lags have potentially been exacerbated this time around with all the liquidity that's put in the system, but it does seem very much that the liquidity hasn't dissolved the repercussions. It's just simply delayed them, right? And even not very much, as Steve is saying, that Milton Friedman basically said it's about 2 years, and when you look at it with a 2-year lens in terms of major changes in money supply, it's about right. Certainly let Steve again peg on the nose the 9% inflation prediction. And even though he was expecting us to get to 2% by the end of the year, and he's like, well, maybe that's going to be 2.5, maybe somewhere between 2.5 and 3. That's definitely good enough for government work along the timeline. But I think the important thing to take away is that he says, look, we're going to get to 2% or maybe even a little bit lower in 2025. And he feels quite confident that a recession is going to happen as well. And so, I think you have to sort of respect the math, and, we'll see what happens. We'll have you guys on every week helping us try to get a sense of the unfolding reality on the ground. But I think you can't just be happily in the no landing, soft landing camp with the type of math that Steve lays out there, unless you've got a really compelling, strong argument otherwise. One thing I also want to note here too is there's a lot of there's been a lot of data we've been looking at for a long time that is sort of recessionary, but there's been a lot of other data points that haven't been a recession, and there's been this big debate that folks are well aware of between hard landing versus no soft landing. One of the data points that's been sending a warning signal for so long, I think we've all become numb to it, has been the inverted yield curves. And I just want to pull up this chart that Tavi Costa at Crescott Capital circulated today, which is sort of showing us where we are right now on the yield curve story. And if you look at it here, he's basically saying, hey, everybody, the yield curve is beginning to uninvert. We still have a good ways to go, but you'll see here this dotted line 70% threshold here on the chart. Once you kind of drop below that on the way down, when the curve starts to uninvert, that's typically where the repercussions of the yield curve uninversion start to become manifest, right? And so we're not there yet, but the momentum is definitely down to that level. And so, Tavi's is basically saying, we got to watch this really quickly. But if the current trajectory continues, then it looks like we are starting to head into the story where yield curve uninversion then ushers in a recession. So again, not there yet, but we're going to have to watch this really closely. All right, Mike, coming over to you, my friend. What else would you add in addition to what John did?
A couple things. Steve pointed out that he thinks that stocks are overvalued. We absolutely think that stocks are overvalued. It's been a bit of a broken record, I know, for people that have been listening to us or anybody talking about valuations being extreme. But just a couple weeks ago, you had John Hussman on your site, and we really do admire his work and his data. And I wanted to just share, if I could, Adam, his latest piece. And I'm just going to share the actual article because I want to share two different charts and maybe point out where people can see these articles for free. And so that's coming up right now. So this could be found at husbandfunds.com. And this particular chart here is really John Hussman's favorite valuation metric, the non-financial corporate gross value added. So this chart goes back 100 years, essentially, which is why I like it so much, why we like it so much. We think that this model is very rigorous and that it's very highly correlated to actual returns over the next 10 or 15 years. Now, anyone looking at this will say this has been wrong for a long time. I would admit that we've been early and wrong for a long time, but valuations, we can't stress enough, will matter in the long term, right? So if you're looking for one metric that you can divorce from all emotion, that will matter as to what your forward returns are going to look like, it is valuations. The problem with valuations is that they're extremely bad at timing, particularly in this bubble. This time has been different for longer than ever before in terms of keeping valuations high without a correction. Every time the market's tried to correct, it's been bailed out by money printing. But still, take a look at this. This is July 17th. Here we sit at July 24th, 2024. This is about a week ago. We are at the tippity top of valuations over the last 100 years. Even the 1929 instance wasn't higher. It's maybe the same. Really, if you look at the last 8 years or even the last 10 years, we've been relatively stretched to the upside. John Hussman puts this in a scatter plot. If I scroll down to this, I know you've shared this chart many times on your channel, basically looks at follow-on 12-year returns in the S&P 500 with using, and is using that data above. So basically the thing that John Hussman does that we don't see others doing is that he'll look at what the returns actually were over the next 12 years and then plot them against the data that I just shared. And here 716, one day off of the other data above, but basically the same, shows that we can expect about a minus 6% return, the S&P annually, nominal over the next 12 years. It doesn't tell us what the path will look like. So I know we're probably beating a dead horse on valuations here, but I think it's important to point out. So that's the number one thing I'd point out.
Hey, Mike, just before you move on, real quick, looking at this chart and the one above, and I'm mentioning this mostly for the folks that are listening on a podcast and can't see the chart. The key takeaway here is you have two different data sets, two different ways of looking at valuations, going from 1928 to today, right? So almost 100 years worth of data. And we are at an all-time extreme in both data sets.
And it has been for a number of years, and I'll stop sharing, but it has been for a number of years, Adam. And so that's what critics would say. It doesn't matter anymore. This time is different. And I'll be the first to admit that this time has been different for longer than ever before in recorded history, at least the history that I study. It won't be different long-term. There's a lot of other things we can talk about short-term, and we will get into that in a minute. Short-term, the market is looking a little weaker, though intermediate term, it's still looking fine. Big picture, though, for people that don't want to mess around, bottom line, 5% Treasury bills is a good place to stay, and gold. And so I'd like to mention, Steve mentioned gold. He's a fan of gold. We are too. He's a fan of land. We are too, within reason. That's it's a bit. There's some areas that are bubble-like, so you got to be careful with land and real estate. But in general, real assets is what he likes. He talks about the Swiss franc being the only currency that really preserves its purchasing power over time. Well, I can't really recommend the Swiss franc, or I don't really know. I can say that we don't follow it closely enough to make a recommendation, but I thought that was interesting. So, overall, I think that he's in alignment with our viewpoint that stocks are overvalued, real assets make sense, hold a lot of cash for better opportunities. And, I think we're very late in this game. And we still think the market's maybe going higher here near term, but there's some short-term cracks, including today. I just looked up at my screen. The S&P 500 was down almost 100 points. As of right now, it's down about 92 points. So this is different action that we've seen in a long time, Adam.
Well, let's actually talk about that for a sec. So last week we saw some interesting market action where there was a pretty strong rotation of capital out of big growth stocks into the Russell, into the smaller cap stocks. And we've been talking all year basically about the bad breadth of the market, right? That it was such a very few number of stocks that were really driving all the market gains, and that the rest of the market had kind of been left behind. One could say, oh, well, this is a positive sign, right? Where there's, the market's starting to broaden out, more companies are participating in the upside, and that would be a good and healthy thing. But what's driving a lot of the action today is we had earnings last night for Google and for Tesla. And I think both disappointed the street's expectations in terms of their outlooks going forward. And I think one of the questions this is really starting to raise is, okay, we've been in this Magnificent Seven mania for so long now, and so much of that is built up on AI, right? And the expectations of what AI is going to do. Are we starting to see the bloom coming off the rose here? Are we starting to see the street begin to question, wow, wait a minute, there's all this spending that's been going on in AI, but are we really getting, a clear enough return on investment for that spending? And if not, do we need to start ratcheting down our expectations for these companies? And if so, man, that could really start a cascade, because there's, as we've talked many times about, so much of the current market value is made up of these small AI-driven companies. It's probably too early to say that yet, and we have a number of these companies still to give their earnings going forward. But is that concern that I mentioned, do you think that's playing a role in the action that we started seeing last week, but we see today after those disappointing forecasts? Whichever one you can let's take that. Fine.
I'll take a shot at that. Yeah, we do. And the action we saw last week, and actually the last couple of weeks, in terms of this kind of rotation, if I could use that word, from large cap tech primarily into kind of the broader market, especially small and mid caps, was truly historic. We dropped a whole video on our YouTube channel, New Harbor Financial YouTube channel last week, so I don't want to get into too much about it. It was truly historic. I mean, we're talking about moves that were more extreme in a short period of time than have ever been seen in any market in terms of standard deviations above its 50-day moving average. Truly historic. And one of the big drivers of that, we think, frankly, it was so quick, so fast, it almost had an unhealthy aspect to it. We want to see a broadening of the market. That's healthy. But the way it happened had the look and feel of a very unhealthy underpinning. So, for example, hedge fund.
Sorry, I'll let you continue, but I'm just curious, does that make you think that there might be more mechanical things going on rather than a shift in investor sentiment, like maybe people covering shorts or things like that?
Oh, absolutely. I mean, it's funny because sentiment is very much psychologically driven. So a move can beget a sentiment shift and vice versa. I think that's likely to be the case. But if you look at hedge fund positioning, for example, super long, these big mega tech stocks a couple of weeks ago, very short the Russell 2000. Right around the same time that interest rate expectations were really falling off a cliff in terms of what the Fed is likely to do. All else being equal, these small cap stocks, I think, caught a really strong bid because of the interest rate sensitivity that this cohort of stocks has, because they typically can't, on average, lock in fixed rate debt like large companies can. So their financial profiles are very susceptible to short-term interest rate changes. So the combination of these things, we think, caused a very mechanical, systematic rotation among the big, algorithmic players that kind of fed on itself. It remains to be seen if this is a more durable. Some of the things that we looked at, we looked under the surface of the Russell 2000 and what, it wasn't just one sector. Every sector had positive performance in the Russell 2000 for that 5-day period that was really a massive sea change. The variability among sectors was very small, smaller than average. So it had the look and feel of not a really kind of a thoughtful, nuanced kind of rotation of thoughtful investors. And I love to use the word thoughtful anytime we're on this channel. It means so much. But it had all the look and feel of a massive, kind of programmatic kind of shift. Remains to be seen if it's durable. Today, we see the S&P falling off quite a bit, as Mike mentioned. The Russell is down much less at this particular moment. So it seems like that performance. Don't want to put overemphasis on one day. But that's kind of how we feel about things. We've been more selective in kind of looking at sectors rather than the broad markets, because let's not forget the Russell 2000, something like 30 or 40% of those stocks are negative cash flow companies, right? So a 25 basis point or even 50 basis point drop in interest rates isn't going to be the savior to these companies. And I even think the market has maybe gotten a little too confident. I'll just share my screen here for a second, Adam. This is the latest CME FedWatch market expectations for interest rates. This is at the September meeting. More or less the market's not pricing in much of a probability for a rate cut at the July 31st meeting. But look at the September meeting. So we show the expectations from a month ago, a week ago, 1 day ago, and now. So right now, there is literally 0% chance priced in the market that the Fed won't have dropped interest rates by at least 25 basis points at September meeting. Not too much in life that we are 100% certain about, but the market seems 100% certain that the Fed will drop rates. Okay, and even just yesterday, there was only a 3.8% chance. But look, a month ago, there was still almost 32% chance the market thought that the Fed would not drop even by the September meeting. But look at this: the probability of a two 25 basis point drops at the so you may say a 50 basis point drop at the September meeting shot up to 10% today. That's higher than any time in recent times. It's certainly higher than it was a month ago. But this is perhaps we got a little ahead of ourselves. The market tends to not always get it right. And just a quick final comment on the yield curve and uninversions, or the direction towards uninversions. So we now do have an uninverted, 2-year, 30-year spread, for example. Most of this uninversion or disinversion activity has come in the form of shorter-term rates dropping, as per the market forecast we just saw there. Long-end rates haven't dropped that much. In fact, they've been stubbornly in a range. So when we talk about interest rates dropping and maybe a bull for bonds, there's quite a bit more nuance here, because what we're seeing so far is what's called the bull steepener, where the uninversion is happening by the short end dropping and not the long end rising. We could see, there was a research paper that just put out by Norio Robini and Steve Mirren, I think his name is. He was at the Treasury, that spoke about the what they call activist Treasury issuance. All the massive debt that the Treasury has issued over the last couple of years has been disproportionately in the form of short-term bills. Higher percentage of short-term bills than I think in history, or certainly recent history. And what that has effectively done is it's kept interest rates suppressed on the longer end. And if there's any normalization here to back towards, I think, even a 25% weighting towards bills, that could certainly put up upward pressure on the longer end of the curve. So there's a lot of dynamics here that are really tricky in the bond market that we certainly are cognizant of and are being very careful about. That's why we only have about a 10% allocation to long-term bonds, and we still favor the short end of the curve.
Okay. All right. I just want to note too that we've been talking forever about the levels of overvaluation in the market, and a lot of that's been driven by these AI-driven stocks, which are now down this week compared to where they were just a week ago, right? I just want to note, just today, Microsoft and Apple are down over 3%. NVIDIA and Google are down over 5%, and Tesla is down over 10%. This is just a one-day move, and this video is going to come out a day or two from now, and who knows what'll have happened by then. But those are pretty painful one-day moves, especially if you're holding a basket of stocks that's heavy those companies, which honestly, a lot of people's portfolios are probably even more so than they realize, given how many ETFs have to own those companies. So my point is that we have been warning about this because when the price corrections start to occur, they can occur a lot faster than folks realize. And I think most folks owning these stocks who are beginning to become a little bit skeptical about their future have probably been telling themselves, yeah, when I start seeing the warning signs, I'll start lightening up on these positions. But then again, example with Tesla, you went to bed last night and everything seemed okay. You wake up this morning, it's down over 10%, right? Those folks obviously didn't get the chance. And just mathematically, 100% of investors can't be the first 5% to decide to get out of a stock in time. So who knows what's going to happen from here? As Mike said earlier, this market might still even, pick itself back up and run to even higher all-time highs from here. But I think this just gives us a good reminder of how quickly the markets can turn, because again, it's not just these top stocks. These top stocks have been representative of so much of the market value of the key indices that when they get sick, so do the indices themselves. The S&P is down almost 10%, or sorry, almost 2% today. Is this going to be, are we seeing kind of the change in trend here? And for those that have been waiting for the market to roll over, is this the moment? None of us have any clue. I just want to underscore the fact that when valuations have gotten as overextended as they have gotten at this point in time, the price corrections can be more violent and more swift than most regular investors imagine.
Adam, totally agree. And some of those stocks that you just mentioned, Google down 5%, Tesla down 10%, Nvidia, I think as we speak, is down maybe 5%. It's all relative. Like we've said right in the beginning of this, we think stocks are hyper overvalued. They represent negative returns from these levels. So the warning is out there. Now, that's not to say it's a cop out and that we don't want to make a call. You have to make some kind of call, though. And I think we've been pretty open about the fact that our call is that we choose to be around at the moment 40-ish% in stocks. You can't be 100% in stocks and trade in and out and expect to get it right. It's just not going to happen, particularly at this time and place where the Fed is all in and the rules have changed and it's been different for longer than ever before. So for most people, I would say don't bother if you're doing it yourself. Stay in something that yields 5% like Treasury bills. For people that have hedging tools like options or other ways to reduce risk, you can try, you can dabble. We certainly have picked what we think are the strongest sectors out of those that are in our universe, and then we participate in those with some hedges. And those hedges, that we've said many times in this program, are crash insurance, because this is a crash-prone market. There's no doubt about it. So, we're always forced to guess, right? We have to have a viewpoint, and our viewpoint is that we haven't seen any real evidence that the move is over, even though this is a pretty big down day, and it's going to be disappointing for a lot of people because we had a nice pullback to near the 50-day moving average, particularly on the NASDAQ, and then a nice bounce from there that looked like a recovery that most people have been so used to over the last bunch of years. And now it's rolled over. And I'd be happy to share charts in a little bit if you want. But the bottom line is the NASDAQ is threatening to close below its 50-day moving average as we speak, and the S&P is approaching its 50-day moving average. And so the NASDAQ is the weakest of them all. And it's been the strongest on the way up. It's the weakest on the way down. That makes sense. The real question is, do we put a fork in it? Is this thing done? Yeah, I don't think so. But I would absolutely be selling your weak positions. I'd be raising cash. Frankly, should have done it a long time ago and been at a lower allocation. But if you haven't done it yet, absolutely do it now. Raise cash, get down below 40% stocks, 30% stocks even. There's great alternatives out there. And so we'll see. It's very early in the earnings season. Google and Tesla disappointed, but Microsoft is next week. Apple, I think, is next week. The bottom line is it's early in the season, and one big or two big blockbuster surprises to the upside can turn the whole ship around in a second. So it wouldn't be until we're down, maybe even down as low as 5,200 on the S&P, or even a little lower than that, crossing through 5,000 on the S&P, that we would really start to think that the market has broken some major trend lines. And I think even Sven talked about this the other day. I think in the same kind of range. He thought maybe down to 4,800 or even 5,000. Well, from a technical perspective, we could say, yes, the market's broken. But so far, the S&P is only down 3-4% maybe max, and the NASDAQ's down about, I think, 7 from the high. You know, let's put it in perspective. We're definitely not raging bulls here, but you know, we think it's a high likelihood that we bounce higher. It's very hard to pick the top.
All right. Well, we'll be very closely watching over the next week or so, you know, the technical levels. You talked about the 50 DMA. Does that serve as support, and do we bounce off that? Or if we punch through it, what does that tell us probabilistically about what's going to happen next? All right, gents, we got to start wrapping up here. But two quick things to give you guys a chance to opine on before we wrap up here. One is, okay, so I'm hearing more chatter from this viewing audience of people looking at the markets and just saying, I'm getting a little bit nervous. I'm getting jittery about where the markets are. And first and foremost, too, I should say that both Lance Roberts and I believe you guys as well have said, hey, look, you know, markets have gotten so overbought. A 5 or 10% correction would not be unexpected here at all, and it would be perfectly normal and natural, right? And maybe that's what we're beginning to see in the process of happening here, right? So, but maybe not. And so my question is, what would your counsel be to people who are saying, hey, I've kind of been enjoying the ride, but now I'm getting a little bit nervous. What should I consider doing in my portfolio? That's point number one. Point number two, which we can close on, but I'll just put it out there, is I talked a lot with Lance this past weekend about the wisdom of if you are the person in your family, your relationship, your family who is in charge of managing investments. What we see way more often than we'd like to see is if that person ends up dying first, they haven't identified who they wanted to pass the torch for those responsibilities to in their family, and their spouse or their children basically find themselves having to take over those investments, feeling very overwhelmed. They don't have the experience in how to manage them. They might not even know where the assets are, what accounts they're in, how to access those accounts, et cetera. And so I do want to reserve just a minute at the end of this discussion about how you guys, you know, help people basically create a transition plan while everybody's still alive, and make sure that when the inevitable happens, hopefully it happens the furthest day out as possible in the future, but that when the main person running investments for a couple or a family passes away, the rest of the family is as prepared as possible to receive it. So anyways, who wants to take the first question about advice to people that are getting jittery right now?
Well, we'll divide and conquer. I'll take the first one. I'll pass the baton off to Mike for the second one. So what we would tell, so we've already presented a case and some really compelling charts, for example, of the sort that John Hussman has put together. You know, so everyone should be asking themselves: are they an investor? Are they a short-term trader? And what does this money mean in their life? Is it something that it should be kind of played with in late stages of a hyper overvalued market, or should there be restraint in the context of, hey, this is money that's got to be there for me for 30, 40 years during my retirement? And with the kind of mathematics that current valuations portend in terms of what the returns over the next decade are likely to be, if history's any guide, it absolutely demands, warrants, whatever forceful word you might use, a prudent investor to take some chips off the table. We've explained that we're about 40% in equities for our clients right now, but even there we have some relief valves. We've got put options on the S&P 500 that are about 4.75% below where we are right now. So a further 5% move down, for example, in the S&P would instantly take about 15% of our client stock market exposure off the table. We are at record valuations. There's no way, that's black and white. It's not debatable. And we're at a time where we're seeing some economic slowdowns. We're seeing kind of monetary policy, kind of struggling to balance the objectives of, inflation containment and this kind of thing. Point being is there's every good reason. I would submit that one's own psychological trappings are what might be keeping them from becoming more defensive. And we're happy to talk with folks. Sometimes just talking it through is enough kind of medicine to kind of have the willpower because it is hard to sell, especially things that have gone up, because the human mind wants to extrapolate into the future. So bring it back to the, why you're investing. Try not to fool yourself that we're in anything but a late stage of a very overvalued market that will at some point revert in some, we think, significant way to something of pretty significantly lower prices. And that's the time to be more invested and thinking about how to create long-term returns.
All right. Well said, John. All right, Mike, we'll close with you on, what a firm like yours, doesn't have to be a firm, but a firm like yours can do to help people come up with a transition plan while everybody's still in charge of their faculties, still alive, still getting along well together.
Adam, we wear a lot of different hats here. We often talk about our money manager role here and investment manager role. And that's a big part of what we do. But also another big part of what we do is financial planning. John and I are certified financial planners. We don't mention that probably too often here, but we are CFPs, and we do get into financial planning with people. And so it could be standard financial planning like retirement planning. It could also be a person thinking about selling a business and wanting to think that through. There's a lot of psychology involved in some of these decisions. And so another hat that we wear is that of psychologist. And so when we wear that hat, we often help bring families together. Sometimes we help husband and wife talk openly for the first time in a while. Sometimes we've had that experience. Other times it might be having a conversation with parents and children together. We've had a lot of different experiences. I personally have had experiences in the last month where several people in their 80s have wanted to speak with us, not because they don't want to be the person to carry that torch to manage the investments anymore, but they're starting to either feel their mortality or doubt their judgment, or frankly just want to do something else. And so a lot of times people just want to get a trusted advisor on board so that they have that contingency plan checked off. So as certified financial planners, we help people make sure that their thinking or their plan is on target, make sure the documents are in place, make sure that all the right questions are asked. And then, as psychologists, we get together and help people or families talk about these things. And, lastly, as trusted advisors, I think that people just feel better that we're there should something happen unforeseen suddenly. They just feel better. And so that's a big role for us, and we're happy to do it.
Yeah, well, thanks. And the reason why I just want to emphasize this is it's something that on a relative basis is easy to do, doesn't take a ton of time, cost, or effort. But when you compare it to the cost of not doing it, which, as I said, tends to happen more often than not, and feel free to contradict me, but you guys see this, you're there on the front lines of this. People don't like talking about their mortality, or they get unexpectedly sick and pass away or whatever. It's something that they meant to do, but just never got around to it. And these things can really tear a family apart, right? Make people feel very overwhelmed. Oftentimes they make terrible decisions when they're overwhelmed. Obviously, if there's not a clear plan, you start to get, the opportunity for infighting inside families. Just seems like such a loving act to do to those you care about, and almost such an act of neglect to not prioritize, especially when it's so relatively easy to do. So, I did a poll of my audience this week and asked, hey, who has a plan in place? Who doesn't have one in place, but says I'm going to make it a priority soon? And then who doesn't plan to do this, most likely because you don't have heirs, right? And I think it was about a third of the people said, I don't have one in place yet, but I'm really intending to do it soon, right? That's a really big number, right? That's 1 out of 3 people. And I just want to mention, we're all procrastinators, whether we can admit that to ourselves or not. It's always easier to say, yeah, I'll get it done tomorrow, this is the kind of thing I think you really just need to say, look, I'm going to do it soon, and really hold yourself accountable to that. So the sort of the challenge I'm putting out there to these viewers is, if you haven't done this yet, make it a priority to do this year. Figure out who you want the agent to take the torch from you is going to be. Maybe it is your spouse, maybe it is a child. But if not, if they're not interested or don't feel like they have the capability to do it, then find, the right person for that. And in most cases, that's probably going to be a professional. And again, I'm agnostic who you work with, just as long as it's somebody good who has the right expertise and has your family's best interests at heart. All right, well, we're going to have to wrap it up there. We didn't even talk about gold yet, which has kind of had sort of an interesting run over the past couple weeks. But Mike, maybe we'll dive into that with you next time we come back on here. But gentlemen, thanks so much for being with me for another week. Everybody, if you enjoyed the conversation with Steve, would like to see him come back on the channel, please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And folks, we're just a couple hundred subscribers at the time of this recording away from the big 100,000 subscriber milestone here on this YouTube channel. So if you're one of the 50,000+ people watching this video who hasn't subscribed to this channel yet, it's totally free. It only takes you a couple seconds, and it'll really help us to hit that 100,000 subscriber milestone. And if you'd like some help in trying to figure out how to allocate your portfolio based on the trends and outlook that Steve shared with us, or some of the tactics that John and Mike have talked about here, if you don't already have a good financial advisor who is being your financial quarterback through all that, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. It only takes you a couple seconds. These consultations are totally free, and there's no commitments to work with these guys. It's just a free public service that these financial advisors offer. So make sure you avail yourself of that resource if you haven't done so already. And while you're at the Thoughtful Money website, if you haven't done so already, just take a second and click the newsletter link up at top and subscribe to our free newsletter. All right, John and Mike, thanks so much for hanging with me for another week. We'll make sense of what the markets are up to over this next week when you guys come back on later next week. Thanks so much, guys. Everybody else, thanks so much for watching.
Thank you, Adam. We'll see you next week.
Thanks again, Adam. Always a pleasure. We'll see you soon.